Good morning and welcome to the Killik podcast for the 4th of December. Big day in markets yesterday. So we've been talking a lot about divergence of interest rate policy between the US and the European Central Bank. And yesterday we had this ECB meeting where Mario Draghi came in with his proposals for QE for the coming months. And they dropped the deposit rate and they increased the period in which they're going to exercise QE, but they didn't increase the amount of QE that they're going to implement. So that was seen as a disappointment for markets. And we talked about this last week. We felt that the markets got a little bit too one way on that trade and very short euro, long dollar. And we saw a very sharp reversal of that with big ramifications for all sorts of asset classes yesterday. So we saw a 4% spike in the euro against the dollar. A 3% drop in the main broader European index, a 20 basis point rise in German 10-year yields, and a 4.5% fall in the S&P 500. So what do we learn from this? Well, firstly, as I say, the divergence trade was far too long in the tooth in a sense, and you know what we're seeing in markets, an extension of certain trades because of more algorithmic trading and momentum strategies out there from hedge funds, and a lot of those stop losses were pulled, which created that very exaggerated move yesterday. We also saw that European markets are being heavily influenced by currency and hedged ETF trade flows. So there's a lot of US investors and foreign investors coming into European markets on an agnostic basis in terms of which stocks they're buying, and they are buying the European basket of stocks on a hedged basis, so they're not actually exposing themselves to the euro. So yesterday, when you saw that very sharp movement in the euro and a fall in the market, those ETF traders were losing on both ways. So you saw a sharp pull of those positions, which exacerbated the move in the market. So this goes back to this first point, that currencies are key drivers for portfolio returns at the moment and exacerbating volatility there. Thirdly, we did see quite a downward shift in the S&P of 1.4%, which typically, if the currency had weakened against the sort of global currencies, and we'll go on to talk about that a little bit more in due course, you would see a rise in the equity market there. But clearly, US investors were hoping for more liquidity into the global economy. And we've said this a number of times, that QE in Europe doesn't mean that money doesn't end up in the US market. And I think the US investors were hoping for a little bit more liquidity to cross the border into the US, which obviously isn't going to happen in the near term. So this reversal of the trade-weighted dollar, so this is against all other currencies rather than just against the euro, is quite a big deal for the market, and where this chart goes over the next 12 months will be very important for asset classes. So a strong US dollar puts, as we talked about, pressure on emerging markets and their funding positions, pressure on commodities. It also means that we see deflation in the US economy, which means that there's no pressure on the Federal Reserve to raise rates. So if the US dollar starts to depreciate, you start to see more inflation coming from commodities, coming from import-led inflation coming into the US economy, and therefore the inflation rate goes up to 2%, which pushes more pressure on the Fed to raise rates. So that has big ramifications for what happens next year, which we'll talk about in the next slide. It also, if this pressure comes off the US dollar, you also see the easing of pressure, more competitive trading situation for US manufacturing who are exporting to the rest of the world. So that's pretty key. So as you can see from this chart, this week we saw for the first time in a very long time that the US manufacturing PMI crossed over the Eurozone manufacturing PMI. And that's basically saying that people feel that the US manufacturing industry is now in contraction because it's below 50. And obviously the Eurozone is benefiting from this cheaper euro and is starting to stabilize and starting to accelerate. So that has political ramifications for the Federal Reserve, and that's one of the reasons why they don't want a particularly strong US dollar, and a strong US dollar takes away the pressure for them to raise rates. So back to this rate argument, one of the key moves yesterday was that on the US Treasury curve, the longer dated bonds moved up more than the shorter dated bonds. So you saw a steepening of the Treasury curve, as you can see here. That is symptomatic of better growth, a better growth outlook for the US economy in future years, and tends to be good for markets because you get a bit of a PE re-rating when people feel that growth prospects have improved. But one of the sort of more important short-term ramifications of this is that the market is now starting to price in the likelihood of more rate rises in the US economy in 2016. So, I think we can take December's rate rises as something that is largely set in stone, although we're going to get a jobs report today which will probably confirm that. But the amount of rate rises we're going to get in 2016 is not set, and some market participants think we'll get 3 rate rises. Some people feel we'll get 2, probably in the second half of 16. And that has a major influence on equity markets going into next year. So this steepening of the yield curve suggests that the likelihood is that we'll probably get a sort of less flat trajectory for rate rises, and we've got to take that into account into the way we build portfolios. So the other big thing this week that we talked about is OPEC. The actual OPEC meeting will be this afternoon, but we've had a lot of press sort of release and rumour ahead of the meeting. At the moment, I think the market is expecting them not to cut production, but soften their very hardline approach to wanting to expand production, take out those high-cost producers. So, what's becoming clear is Saudi Arabia, as we mentioned, will not cut unless Russia and Iran cut in tandem. And I think this week we've seen more evidence to suggest that Russia and Iran have no intention of cutting their production rates at the moment. So we think that near-term oversupply will continue. It's about 1 million barrels a day at the moment. And that, coupled with falling Chinese demand, which I think will accelerate in the second half, continues to put pressure on the oil price in the near term, which is important for our oil positions. However, what we are seeing is that US shale, which is probably now the swing producer rather than Saudi Arabia, is starting to feel the pressure of tighter financial conditions. So here we've got the US high yield spreads in the market that just shows that the cost of financing for a lot of this index is US shale is starting to increase and ratchet up. And that means that their ability to continue to increase production or maintain production levels is starting to be inhibited. So we'll probably start to see more evidence of shale coming back from the market in the market next year. The week ahead is very quiet in terms of corporate news flow. We've got probably the most interest. We've got Ashtead on Wednesday. Costco is always quite interesting in the States. And then we've got TUI, Sports Direct on Thursday, and Inditex. Inditex will be interesting just to get a gauge on the consumer. This is at the fast fashion end of retail, and also get a sense of what wage cost inflation are doing to margins. So that's it from me. Thanks for listening. Have a good weekend.